How's everybody doing on this Saturday night? I hope everybody's having a great time out there. But I welcome everyone here to the strategy room for this special edition. This is the crypto series, and I thought I would kind of kick everybody off tonight by I'm going to bring up a little kind of PowerPoint slide here just to show everybody what we're gonna cover tonight. Now, this is I did decide to do this as a live stream, but this is not the normal live stream. This is not the normal strategy room that I do on a weekly basis. So if I can give everybody a little bit of context here. So I started out probably a little over a year ago doing what I called the crypto series, or what eventually evolved into the crypto series. So I've always been very curious, very fascinated by cryptocurrencies and Bitcoin and blockchain technology and all, and so on and so forth. So I wanted to do a couple of episodes on the history of Bitcoin and blockchain and how cryptocurrency kind of evolved from the start. And so I did a couple of book reviews on a book called The Dark Net, and then this was right around the time 2001, end of 2002, where FTX kind of imploded and blew up, and then Michael Lewis wrote the book about FTX called Going Infinite, which I found absolutely fascinating. And so I did a book review on that. And then that kind of morphed into all the different things that happened, like kind of the crypto collapse of 2002, and then the banking crisis that we had in the early spring of 2023, and then kind of has just kind of run and evolved from that space. So what I'd like to do here tonight, if we look at my little PowerPoint slide here, I want to do basically a very, very quick recap of the crypto series. I've done 11 episodes so far in the crypto series. So I just want to kind of recap that for everybody tonight. That'll kind of give us a lead in to what we're going to do here through the rest of the time. I want to give you guys, I have a little bit of kind of the latest cryptocurrency news, some of the things going on. So I want to run through that again very quickly. And then I want to get to the meat of basically what we're going to be doing here tonight. And that is I've got two articles. One is from ICBA, and this is called The Cryptocurrency Debate. And we're going to talk about basically the debate about, particularly like stable coins, like how should crypto and in particularly stable coins be regulated? So we're going to talk about that a little bit. And then an article from Pew Research, which basically says, the majority of Americans aren't confident in the safety and reliability of cryptocurrency. And there's some really interesting stats in that article, some really good things I think I could point out to everybody. And then I basically have 4 papers that just came out here within the last couple of weeks. 2 of them are from the Financial Stability Board, and the one is called the Financial Stability Implications of Tokenization. The second article is basically for the G20. It's a crypto asset policy implementation roadmap. And then the other 2 articles are from BIZ, the Bank of International Settlements. And one is called Tokenization in the Context of Money and Other Assets, Concepts and Implications for Central Banks. And then the final one is just stablecoins, money market funds, and monetary policies. So some very interesting things, some very interesting updates that have come in those 4 papers. And so we're gonna go through all that tonight in this episode. I'm hoping this runs about an hour, but if it runs a little over, so as long, however long it takes to get through this information. So, but hopefully not too long. So, but okay, so I want to jump out of that for just a second because I am going to I'm going to flip over here to one of the articles here first. So let's go to that, but I'm not ready. I'll tell you what, I'll bring that up, but I'm going to go away from that for just a second. So, okay. So first I just want to do the recap real quick of the crypto series. So like I said, I've done 11 episodes. That basically started out, and I'm just going to run through real quick here. So part 1 in that series is a book review of The Dark Net. It basically covers the years of 2008 to 2014 and basically gets into the birth, the creation of Bitcoin, and then, blockchain technology, and then what evolved into cryptocurrency, and, kind of the very early years of crypto, and basically how it evolved from, nothing, how it basically evolved on the dark net, and then kind of made its way into more mainstream. And then the second part is the book review, again, like I said, of Going Infinite, the Michael Lewis book. And we kind of cover the years from 2015 up until 2022. Ultimately, the book follows FTX and Sam Bankman-Fried and basically his, kind of adventure through the crypto world until it all imploded at the end of in October, late October, early November of 2022, basically 2 years ago now. When FTX completely imploded and you had the $8 billion fraud, of which he was convicted and is now going to be spending a very long time in jail for that. And then so the first two episodes there basically kind of give the history of crypto, if you will. And then part three and four, I get into very specifically. So part three, I get into the crypto crash of 2022. And I really explain how the crypto really imploded, how it started in basically May of 2022 with the implosion of Terra USD, which was a stable coin, and then basically rolled through the entire crypto market, and about how you had about, I'm trying to think the number now. I think you had about 19 crypto firms that failed. You had Voyager, Blockchain, Gemini, Genesis, was it Celsius? I forget all the names off the top of my head, but there was a ton of crypto firms and companies that basically went kaput, and it all rolled up into the final coup de grace, if you will, with the implosion of FTX, like I said, in October and November. And then that led directly into the banking crash of 2023 in part four. And my personal take, my personal opinion is that the crypto crash of 2022 directly led to the crash of the 3 or 4 banks right there at the beginning of 2023. Because all the 3 main banks involved in that crash, Silvergate Bank, Signature Bank, Silicon Valley Bank, those 3 banks were all the banks that were heavily invested in crypto. And that, these banks had problems, they had underlying issues, and everybody kind of focuses on those underlying issues. But I believe that crypto and the run on crypto was the match that lit the fire and basically set those banks ablaze, so to speak, in a certain sense. So I go over that. Then I kind of detour. Part 5 is a review. I watched this Netflix documentary series called Bitcoin, which I thought was great. And so I did a review of that Netflix series and basically just showing a really good example of how, kind of the Bitcoin craze just, caught the imagination and kind of caught the greed of just the everyday person on the street. And, this guy got involved in Bitcoin, and he was, they kind of, rented high-end sports cars, did some other things, but it was a really kind of very, very entertaining story, to say the least. Okay, and then part 6, I get into, so Heartland Tri-State Bank, that was the 6th bank that failed in 2023, but Heartland Tri-State Bank was a very small bank down in Kansas. I think it was less than 100 million in asset size, but what made that so fascinating was that it was not the crypto per se that caused the bank failure. It was that the CEO got caught in a crypto scam and then proceeded to embezzle about $40+ million from the bank. And then it all blew up in his face. And then that literally was enough to sink the bank. And it was an interesting story because the regulators were very tight-lipped about what had happened there at first, and then it slowly kind of leaked out. It took about 6 months, 8 months, 9 months, but the story slowly crept out that basically that this guy got the CEO, who was a very well-respected banker, but he got caught in what was called basically a big pig butchering scam, crypto scam, and it was just crazy, but because this guy was he was a very well-known, very well-respected banker, and he was the CEO of the bank. And it wasn't a situation where this guy was not like an amateur. This guy was this guy had been in banking for I think 30+ years, something like that. So this was a highly experienced professional who was really good, and yet even he fell prey to this whole crypto scam. So then in episode 7, I get into Binance. It's called Binance in Trouble, BlackRock in Love. And I basically talk about how, all the problems at the time that Binance was going through, all the the lawsuits, different things that they were charged with. Binance eventually ended up settling a lot of those things. And then I talked about how BlackRock basically has kind of fallen in love with cryptocurrency, how they're trying to roll out all these different crypto related ETFs, and how that's, kind of the game. I mean, Wall Street is in certain respects is very much in love with crypto these days. And then as kind of a follow-up to episode 6 with the Heartland Tri-State Bank failure with the CEO there, I did an episode on pig butchering because that is exactly what he fell into. So I wanted to explain what pig butchering it was, how does it work, how do they get people involved in it, and then kind of what rolls from there. So it's a very interesting episode if anybody gets a chance to check that out. And then episode 9 was Customers Bank hit with enforcement action over crypto and digital assets. And again, I found that very interesting because Customers is tried to basically, after Silicon Valley Bank and Signature Bank failed, Customers Bank basically tried to pick up the football, if you will. They tried to pick up the football and run with it and basically said, okay, now we're going to become kind of the premier crypto bank in the country. And they've already gotten themselves in big time trouble here with, obviously, hit with an enforcement action. They've got to hire a third party company to do a whole review of all their crypto assets and stuff like that. So it's going to take them a little time to kind of work themselves out of that. That's for sure. I don't think, bank's not going to fail. Bank's not in any danger of failing or anything like that. But this is definitely an issue that, it's kind of gets into it kind of ties into like the what I call like the cannabis or like the marijuana issue, if you will. So a bunch of, like, when you consider cannabis, like, a bunch of states have made it legal, but it's still illegal on the federal level. And basically all banks have to be insured by the FDIC. They have to have, FDIC insurance on deposit customers. Being FDIC is a federal regulator and covers all banks across the country. You have to, as part of your agreement with the FDIC, you have to comply with all federal laws. That's part of getting your insurance through them. And so the question becomes, like, technically you could do business with some of these cannabis companies or whatever, because it's illegal in your state. But, could you get in serious trouble for that? Like, in other words, could the FDIC decide to come in and basically say, hey, you know what, you're dealing with a bunch of companies and customers that are still considered illegal under federal law. Therefore, we're pulling your FDIC insurance. So, and I think that crypto kind of falls into that same kind of category in a way. It's like you can do it, but there's still a very good chance the regulators might come in and say, what are you doing? And we're not happy with this, and we're now going to pick on you. And that's basically exactly what happened with Customers Bank, I think. And then I think the regulators are already on edge with what had happened with Silvergate Bank and Silicon Valley Bank and Signature Bank. They already saw those failures there. They already saw how they were all involved in crypto. And so I think that, seeing Customers Bank jump into this, they were basically like, yeah, we don't know about this. So but like I said, it'll be interesting to keep an eye on Customers Bank and see what's happening there. And then episode 10 was called The Rise of Tether. And I talked about how Tether has basically grown into the largest stablecoin company out there, and how they've basically taken Terra USD, who failed in 22. They've basically taken over, Terra. Terra was the biggest stablecoin. They failed. And now Tether has basically taken over that spot, and they've really grown into a massive company. So I talk about Tether there in part 10. And then finally in part 11, I get into, crypto fraud. I get into a bunch of different types of crypto fraud, how they're being perpetrated, the demographic groups and the age groups that they're being perpetrated against. So basically, mostly people 60 years and older are getting hit with it's basically like elder fraud in a very real way. Like people would they used to run mortgage scams and things on elderly people. Well, now it's now the flavor of the month is crypto scams. Call up the 60+ year old and try to get him to invest some way, shape, or form into crypto. So I talk, but I also talk about, again, some of the other scams, different frauds that are going on in the crypto. So that's the crypto series thus far, and that brings me to tonight. So I had all this information basically, and I was going to break down all these reports and everything. I was gonna do, 5 or 6 crypto episodes, and I was gonna kind of roll them out over the next 2, 3 weeks. But I decided, didn't really want to do that. I figured it would be better and more timely, given kind of the time sensitivity of some of these reports, that I said, you know what, I'm just going to come out. I'm going to do this crypto special. I can basically do this in an hour and put all this information out there, and then everybody can have it. I will, again, I'm recording this live stream, but this will ultimately become part of the crypto series, as well as the other live stream content. But like I said, I just thought that this medium would be really good for doing this. So, okay. So that's kind of the background on the crypto series, how I got to where we are tonight. And I ran over. So now let's start with, actually, hold on. Before we get to that, I do have some crypto related news that I wanted to share with everybody. So just a couple of things here. Okay. So Visa has entered into a partnership with Coinbase Global and will offer customers eligible Visa debit cards the ability to transfer and withdraw funds from their Coinbase account and purchase crypto. Now, why is that? Do I find that funny? I find that funny because one of the episodes that I did in the crypto series, I did the review on the documentary Bitcoin, which is on Netflix. Well, one of the things that they did in that series was they created a fake debit card that they offered to customers, and the whole idea was that basically you'd be able to buy cryptocurrency, keep it in your digital wallet, and then you could use this debit card anywhere. So basically you'd be able to spend your crypto assets or crypto money. You could go into Walmart, you could go to Target, you could go to BJ's, and you could just use your debit card just like you would your debit card from your bank account, and you'd be able to buy stuff. Problem was, like, they didn't have the technology, they didn't have the infrastructure, they didn't have the know-how, they didn't have anything to make this a reality. But Visa certainly does, and Visa is now partnering up with Coinbase to basically offer this very thing. So I just, like I said, I thought that was really interesting, and I thought I'd share that with everybody. In addition, Coinbase Global, they just pledged $25 million to Fair Shake, a digital asset sector political action committee, which Bloomberg News reported on, citing a social media post from Coinbase CEO Brian Armstrong. Fair Shake will use the money to support pro-crypto candidates in the lead up to the 2026 midterm elections, according to the report. Now, why do you think Coinbase would be doing that? Well, one of some of the things that we're going to talk about here in just a few minutes are, the potential regulation that's coming down the pike. And obviously Coinbase really wants to be the first truly legitimate cryptocurrency exchange based here in the United States. Like that's kind of the holy grail. That's what FTX was trying to do. That's what Binance has been trying to do. Everybody wants to come in to the U.S. They want to get into the U.S. market. They want to get that legitimacy. That's why Sam Bankman-Fried was throwing around all the money to a bunch of the politicians. That's why he had Tom Brady doing commercials for him, because he was trying to legitimize the FTX exchange, the business itself. And he was trying to kind of grease the wheels, and he wanted to play a key role in the regulation. Another thing you could relate this to right now is AI. What is Sam Altman and a bunch of the other big players in Silicon Valley doing right now? Oh, they're trying to grease the wheels of the politicians. They're saying, oh, well, if you guys are going to write regulation, hang on. We are the knowledgeable fellows. We are, we know everything that's going on with AI right now. So if you're going to write regulation, you need to have us be a part of that conversation. And not only are we a part of the conversation, you really need us to create that legislation and to guide it and walk it along. And we would be happy to hold your hand and walk you along that path. And if we allow them to do that, we're all suckers for doing that. But that's basically what Sam Bankman-Fried was doing, and that's what Coinbase is basically continuing to attempt to do. So former FTX trading director of engineering, Nishad Singh, was not sentenced to prison like his former colleagues, and was instead sentenced to time served by a federal judge. CoinDesk reported. So Singh was also ordered to pay $11 billion in restitution, according to the report. That's It's very interesting. I'd be amazed if he's got $11 billion sitting around. So, okay, the CFTC warns consumers of crypto schemes involving messaging apps. So the Commodity Futures Trading Commission's Office of Customer Education and Outreach released a customer advisory alerting messaging app users to beware of schemes to defraud them of crypto assets. The CFTC's advisory says fraudsters are exploiting the default settings of commonly used messaging apps, telephone networks, and mobile devices to lure users into crypto pump and dump schemes and other scams. It provides actions app users should take if they receive a message from an unfamiliar person or number saying they've been added to a group chat. So it's just kind of interesting, just something to keep an eye on. I'm sure there'll probably be more news coming out about that in the coming weeks as we probably get some reports coming in of people that have gotten scammed. So okay. This is a big one because we're going to get into more of this here in just a minute. So BIZ, the Bank of International Settlements, they dropped a project called mBridge over cross-border CBDC, central bank digital currency concerns. So the Bank for International Settlements has reportedly pulled out of the cross-border wholesale central bank digital currency initiative called Project mBridge. According to Ledger Insights, the BIZ has handed over control of the experiment to the central banks of China, Hong Kong, Thailand, and the United Arab Emirates. Bloomberg reported earlier this week that IMF and World Bank officials were alarmed by the potential for Russia and other sanctioned countries to have a payment and messaging system that could evade sanctions. So while American bankers have not been involved thus far in Project mBridge, the project has been closely watched by U.S. policymakers amid the debate over whether the United States should pursue a central bank digital currency. The Atlantic Council, which is one of the biggest supporters of a U.S. CBDC, previously argued that China will use mBridge to further its goals and to counter U.S. influence in the global financial system. So the House earlier this year passed an ICBA advocated legislation restricting the ability of the federal government to introduce a U.S. CBDC. ICBA has repeatedly expressed opposition to the creation of a U.S. central bank digital currency. So, yeah, I think that's really interesting news that this Project mBridge, that basically the BIZ dropped out. And not only did they drop out, but they turned this over to China, Hong Kong, and Thailand, which is really, and the United Arab Emirates, which I would remind you are all part of the BRICS countries, or are, working together through the BRICS to try to, create or do something there. So it's very, like I said, that's very interesting news. So, okay. So let's get into the first article that we have here. And this is called Suzanne Sullivan-Kinney and Brian Leverder basically engage in the cryptocurrency debate. So despite its popularity and precarity, cryptocurrency remains mostly unregulated at a government level. So to address the unknowns surrounding the sector and protect consumers, ICBA is advocating for clear legislation. So since 2009, when Bitcoin was introduced as the first cryptocurrency, consumer interest in and utilization of this novel asset has ebbed and flowed. Price fluctuations, high interest rates, computer hacks, and a lack of clear regulations have led many to question the practicality and safety of virtual currencies, while also drawing a speculative and even curious interest from others. Secured through cryptography and distributed computer networks, cryptocurrency can be exchanged without the involvement of regulated or insured financial institutions. Instead, the transactions take place outside the traditional financial system in an environment where both buyers and sellers maintain semi-autonomy. High-profile cryptocurrency hacks, such as the theft of approximately $400 million from FTX and the $625 million loss experienced by Ronin Network, have intensified the scrutiny on unregulated digital assets. During the first 6 months of 2024 alone, hackers lifted nearly $1.4 billion worth of crypto from global sources, more than 1.5 times 2023's sum total of stolen crypto. There's also been a rapid rise in crypto investment scams, a type of fraud in which victims are deceived into investing in fraudulent cryptocurrency projects. In 2023 alone, U.S. consumers reported nearly $4 billion in losses to this criminal activity. So combined with several high-profile failure. These hacks have encouraged policymakers to look into how they could potentially govern cryptocurrency markets and stablecoins, which is a type of cryptocurrency pegged to a currency or underlying asset. ICBA has been active in these policy debates since digital currencies were first explored, including raising concerns about Facebook's efforts to develop its own digital currency back in 2019. So then it gets into kind of striking the right balance. So ICBA recognizes the need for clear guidelines on cryptocurrency and stablecoins. However, it is critical that regulatory frameworks effectively address the risks associated with cryptocurrency and safeguard both the financial system and consumers, particularly given the potential for illicit finance in the crypto sector. Additionally, it is crucial to ensure a level playing field for community banks, which already face a complex array of state and federal regulations. One of our paramount concerns is how cryptocurrency provides a potential pathway for mixing commerce and banking. We have spent decades opposing the mixture of banking and commerce. For example, community banks are not allowed to engage in commercial activities. There have been concerns over and fairly strong bipartisan opposition in the past to large commercial banks and big tech companies getting involved in banking, with the key issue being the conflicts of interest and potential risks for consumers. So ICBA worries about large tech companies' longstanding interest in stablecoins and other cryptocurrency, which presents a new challenge to long-running opposition to the mixing of banking and commerce. So, and then it talks about protecting investors and consumers and the financial system. And we're kind of skip over that. So, and then it gets into continued advocacy. So ICBA remains closely engaged with lawmakers regarding proposed legislation to establish a regulatory framework for stablecoin issuance by banks and non-banks. Most recently, ICBA President and CEO Rebecca Romero Rainey published a LinkedIn post outlining the group's stablecoin legislation priorities when crafting these frameworks. She says the association is calling on Congress to ensure any new regulatory framework recognizes the outsized risks that stablecoins pose to consumers in the financial system. We'll get into more in that in one of the FSB reports here that we're going to talk about in a second. Address crypto's role in facilitating financial crimes, such as enabling money laundering and terrorist financing, defrauding consumers and businesses, and evading U.S. sanctions, and politicians using cryptocurrency to put money back from themselves after they scam it out of the government coffer. Oh, wait, sorry, that I added that last one. I added that last one in there. Sorry, that's not on the page here. Preserve the separation of banking and commerce by ensuring commercial firms are not given the significant power of issuing private currency. Reject cryptocurrency advocates' calls for giving states the authority to charter stablecoin issuers with limited federal oversight, which would establish a regulatory race to the bottom ripe for bad actors to exploit. And then finally, prohibit the Federal Reserve from granting master account access to such issuers. Now, what is the issue with the Federal Reserve? Well, the Federal Reserve, contrary to what they say publicly, the Federal Reserve is in fact working on a central bank digital currency. And as a matter of fact, they're working on two forms of it. They're working on what's called a wholesale token, if you will, and they're working on a retail token. A wholesale token, which would be used primarily just among the banks, would be traded among central banks, and it would be traded against all the other banks in the economy. And the retail would be used by individuals, used by people. Now, what the proposal there, or what the thought was from the Federal Reserve, is that they would basically create a master account where they would just issue these crypto accounts to basically anybody in the US that wanted to get one of these accounts. Now, obviously, that's a big deal because now you're basically cutting banks out of the financial system, right? That's a huge thing. That's a huge problem for a lot of banks, and that's what basically the House, when they passed that bill earlier this year, basically said that they wanted to prevent the Fed from being able to do that. They basically say, like, yeah, the Fed cannot just arbitrarily go and pass, they can't just go and arbitrarily create their own central bank digital currency simply because they want to. Now, a couple of things to note with that is that Congress, the House passed that bill, but it went to the Senate, where it basically has died on the vine. Nothing has happened there. I don't think the Senate will ever take up that bill. I mean, maybe they will, but I don't think they'll ever, even next year when they come back in with a new Senate, I don't think they're gonna pull that up and look at that. But then it would have to pass the Senate, and then it would have to be signed by the president. Is the president going to sign that? Who knows? We'll have to see. But again here, so this is like the great crypto debate. So you have to take into consideration, again, striking the right balance. How do you put regulation on stablecoin, but yet not kill the innovation at the same time? Then you got to protect investors and consumers and the financial system. And then you have, just kind of the continued advocacy that's going on, not only by, banking associations, but like I said a few minutes ago when I was giving the news, by, Coinbase, basically getting in legislators in and pushing through and trying to get them to kind of grease the wheels on any potential legislation that might come through. So, all right, I just want to check here for a second. Okay, now we go back there. So, okay, now let's go into the next article here. So, and this is from Pew Research Center. And this is an article that basically says the majority of Americans aren't confident in the safety and reliability of cryptocurrency. So, and there's some really interesting data in here. So cryptocurrency markets continue to face challenges. The currency value has dropped, lawsuits are mounting, and Congress is mulling regulations. Meanwhile, Americans remain skeptical about cryptocurrency, and the share who've used it has not grown in the past 3 years, according to this Pew Research Center survey conducted from February 7th through 11th of this year. And then it goes on to say basically roughly 6 in 10 Americans, 63%, say they have little to no confidence that current ways to invest in, trade, or use cryptocurrencies are reliable and safe. This includes 3 in 10 adults who say they are not at all confident, and a third who say they are not very confident. Just 5% of adults are extremely or very confident in cryptocurrencies, and 18% are somewhat confident. And these findings are largely similar to what the center found in March of 2023. So you can see the little chart right here. It says, 63% of Americans are not confident in reliability or the safety of cryptocurrency. 30% basically not at all. 33% not very. 18% somewhat. So I probably fall in that. I definitely fall into the not at all and not very category. That's 63%. I'm definitely in that group. Some groups of Americans are more concerned than others about crypto and currency. For example, adults ages 50 and older are more likely than younger adults to say they are not very or not at all confident in its reliability and safety. 71% versus 55%. Does that really doesn't surprise me? I mean, after all, the older generations, they have a lot more lived experience. They've been through market crashes. They've been through all kinds of craziness. So they're obviously they've got a lot more lived experience. So they're more apprehensive about are we going to invest in this thing? Are we going to use this or are we not? But I think there's still the practicality of cryptocurrency, right? Like, I mean, it's, at least right this minute, like I can't take my Bitcoin and run down to Walmart and buy a bunch of stuff at Walmart with my Bitcoin. At least I don't think we can, but so it's just, there's not a practical use for it, at least not as of yet. So, there are also differences based on whether people have personally invested in cryptocurrency. Among those who are familiar with but have not invested in it, 82% say they are not very or not at all confident in it. That compares with 39% among those who have invested in cryptocurrency. But on the other hand, 19% of adults who have invested in cryptocurrency say they're extremely or very confident in its reliability and its safety. So, who uses cryptocurrency? So overall, 17% of U.S. adults say they have ever invested in, traded, or used cryptocurrency. And this share is statistically unchanged since 2021. Now, why is that? Well, again, I've reported on all that in my other cryptocurrency episodes. Like starting in 2022, you had the big cryptocurrency collapse. Which again culminated in the collapse of FTX at the end of 2022. And then 2023 saw, kind of a slow and steady comeback. And now it's kind of bounced back, a little bit, but still not the same as the kind of hype and fever that we had around cryptocurrency back in 2021. So, So let's take a look at by age here. I mean, this is a very interesting chart here. So as was true in the past survey, men under 50 are more likely than men 50 and older, and women of all ages have ever used cryptocurrency. So for example, 42% of men aged 18 to 29 say they have ever invested in, traded, or used cryptocurrency, compared with 17% of women in the same age range. 36% of men ages 30 to 49 have done this, compared with 15% of women in this age group. And then by race and ethnicity. So cryptocurrency use also differs by race and ethnicity. So among Asian adults, 28% say they have ever invested in, traded, or used a cryptocurrency, and about 1 in 5 Black and Hispanic adults say the same. While white adults, 14%, are least likely to say they have used cryptocurrency. I thought those stats were really interesting. So, and again, you can see here, so of all US adults, again, 17% have tried cryptocurrency in some fashion. Basically 25% men, 10% of women. And then the age groups, obviously, I think you would expect the younger age groups would do a little bit more than the older age groups, would kind of dabble in the new, latest and greatest technology, if you will. Men, a little bit more adventurous than the women here in this category. And then again, younger women, slight edge over like 30 to 49-year-olds, and definitely over women 50 plus. White adults are basically like the least number to have used cryptocurrency so far, which I find, again, very fascinating. Black adults, Hispanics, Asians, they're all kind of utilizing cryptocurrency in some way, shape, or form. Which again, I find this stuff really interesting. Upper income, 23%, middle income, 18%, lower income, 14%. I guess that's not surprising, but it's because I guess it's cryptocurrency is not hard to use. I mean, basically the gist of it is you have to get a digital wallet, and then you have to sign into some kind of exchange, say like Bitcoin, and Bitcoin, Coinbase. Say you use Coinbase, or maybe you use Kraken, something like that. And basically you take your money, you deposit it into your account at the crypto exchange via your digital wallet, and then you purchase your Bitcoin. You buy Ethereum, buy Dogecoin, buy Bitcoin, whatever floats your boat, whatever your flavor. And so it's really not super hard, but you do need certain things. I mean, obviously you need a bank account, probably need either a cell phone, access to a computer, internet, that kind of thing. But which pretty much most people have, regardless of income level. I mean, most people find a way to get get a cell phone, get internet, get a bank account, all that kind of stuff. But it's just interesting, because I guess I would have imagined that upper income level people would be more inclined to dabble in this than others. And the reason being is because, say, I'll give you a perfect example. Say, you want to move money from the United States to your bank account in Switzerland. Well, if you do that now, you're going to have to do a currency exchange. You're going to have to pay fees on that currency exchange. You're going to have to get it over. It's going to have to be reported to the government. Uncle Sam wants to know when you're, moving money overseas like that. And so it's not a super great or super easy way to do that. But if I do it through crypto exchange, like if I take $1 million and I put it into crypto and then buy $1 million worth of Bitcoin, and then I, transfer that out, and, do the exchange, transfer that out into, and then dump it over in Sweden, I now have, been able to do that with full autonomy. I didn't pay any currency exchanges on that. And I moved the money very quickly from point A to point B. So you could see why, upper income people would be, especially very wealthy people, would be very interested in this. And this is why also, you saw a lot of reports of like, Goldman Sachs, JP Morgan, Morgan Stanley, they started to dip their toes into the crypto market a little bit, because they were getting pressure from their ultra wealthy clients, because the ultra wealthy clients wanted to be able to move money around from point A to point B without having to spend, money on exchange rates and exchange fees and all this other stuff. So you could see why, the ultra wealthy would be potentially very interested in this. income, and then they talk about by party, which is again kind of interesting. So Republicans versus Democrats basically equal, like 18% of Republicans, 17% of Democrats have basically used cryptocurrency. So again, pretty interesting, pretty even keeled there. Some past cryptocurrency users no longer have it. While only a minority of Americans have invested in cryptocurrency, a majority of those who have done so still have it. Among those who have ever invested, trade, or used cryptocurrency. So you can see here out of the total, 39% basically say crypto currently do not have any crypto, and 61% currently do have crypto. So you have this percentage that have basically said that basically they've tried crypto and they don't want to use it anymore. So I would imagine those are probably the ones that got burned in 2022 through some of the fail, whether it was FTX or one of the other exchanges that failed. I would imagine that they were some of the people that got burned there with some of this stuff. And those are the ones that are basically like, yeah, nah, I'm not really, digging the crypto or whatever anymore. So, and then, and then it breaks down here by income. So roughly half, 51% of adults in lower income households who've used cryptocurrency say they no longer have any, outpacing those in middle income, 32%, or upper income, 36% households who say the same. So these shares are similar to those measured in 2023. The only significant change is among upper income cryptocurrency users. 36% have given up the currency, an increase from 21% in 2023. So again, I would estimate that those were people that got burned in some way, shape, or form. Cryptocurrency investments and personal finances. So 38% of Americans who have used cryptocurrency say their investments have done worse than expected. So 20% better than expected, 37% as expected, 38% worse than expected. So interesting there. When did Americans start using cryptocurrency? So about a quarter of Black cryptocurrency users said in 2023 that they first used it within the past year. So let's see here. So within the past year, about 16%, 12% of whites, 27% of Blacks, 21% of Hispanics, 8% was upper, 13% middle income, and 31% lower income. So in the last 1 to 5 years ago, so basically 74% said that they had used it basically within the last 5 years. I totally get that, because I mean, especially if you think of 2019, 2020, 21, 22, those 4 years in particular, you just saw the crypto craze just go through the roof. So it's not surprising that 74% of the people had tried it within the last 5 years. And then basically 75% of that 74%, so 75% of that was basically white, 67 was Black, 72 Hispanics, 76% upper income, 76 middle, and then 61% lower. And then more than 5 years ago, again, which I think you'd expect is the lowest percentage, only 10% of the total. And again, and that follows right on down. So, but I do find it very interesting that within the past year, it's basically been the Black and Hispanic populations that have kind of led the charge here in using this. I just like I said, it's very interesting. Be interesting to see if that how that trend continues. And then it says here, in 2023, Black users, 27% were more likely than white users, 12%, to say they first invested in, traded, or used cryptocurrency within the previous year. Roughly 2 in 10 Hispanic users, 21% said the same. There were not enough Asian American cryptocurrency users to look at their responses separately. In addition, cryptocurrency users living in lower income households were particularly likely to have first invested in it during the previous year. About 3 in 10 users from lower income households reported first investing in cryptocurrency within the past year, compared with about 1 in 10 adults from middle or upper income households. So again, that's it's interesting, right? I really wouldn't have thought that. So, but anyway, so that's the article here from Pew Research. I think there was some really fascinating data in this article. A lot of really good stuff here as far as like who is using cryptocurrency, who isn't using cryptocurrency. Again, just a small percentage of the population, very 17% of US adults have used cryptocurrency in some way, shape, or form. That is still a very small percentage. It's nowhere near as I think that with all the attention that crypto gets and all the media coverage and everything else going on there, I think that a lot of people would have this impression that like, oh, probably 70-80% of people out there have used, cryptocurrency in some way, shape, or form, but that has just not been the case. So, okay, let's work our way through here. So here's the 4 reports here. And I'm going to try to go through these as quick as I can. There's a lot of information here, but I'm going to try to go through these as quick as I can here without basically boring you guys to death. And I'm going to start with the first 2 studies. So these are from the FSB, the Financial Stability Board. And this first one, so if I'm just going to read this here. So this is the financial impact of tokenization. But you know what? We're going to actually start with this one first. We're going to go to the G20 Crypto Asset Policy Implementation Roadmap. It's a roadmap now. Remember that. So this basically gets into cross-border crypto asset activities present regulatory and supervisory challenges. So cross-border crypto asset activities that originate from offshore jurisdictions present elevated regulatory and supervisory challenges to authorities, according to the FSB. And a crypto asset update for the G20, the FSB noted that more than half of jurisdictions expect to reach alignment with the FSB Global Regulatory Framework for Crypto Asset Activities by 2025, next year. The report said that the stablecoin market has grown to around 160 billion, but their use for payment and settlement purposes in the real economy continues to be limited. And then in the other report, the separate report, that said FSB said tokenization could become relevant, but a number of factors now limit its broader adoption in the financial system, including market-related conditions, interoperability challenges, multi-asset transaction considerations, and legal and regulatory challenges. The report noted that tokenized deposits could follow the same practices as conventional bank deposits, but run the risk of introducing financial stability implications if not addressed by regulation and supervision, including the potential for a secondary market. So, with that being said, let's jump into this, and I'm going to just try to blow this up a little bit here so everybody can kind of see this. So basically here, just table of contents so everybody can see this real quick. So there's an executive summary, introduction, market developments, the roadmap progress update, and then key implementations, experiences, and challenges. And then they kind of wrap up with next steps. They do have a nice summary of the implementation survey and the annex at the end. And then they have a nice abbreviations at the end that explain a lot of this stuff. So what I'm going to really go into is basically kind of like I'm going to go into the introduction for a second, and then just very, very quickly blow through kind of the roadmap, progress updates, key implementation experiences, and challenges. So, but I will tell everybody what's key here with this is to you have to read between the lines ultimately of what's really going on here. So, but let's read here. So the International Monetary Fund, the IMF, and the Financial Stability Board have been promoting, supporting, and monitoring the effective implementation of a coordinated and comprehensive policy and regulatory response to address the risks of crypto assets. Coordinated and comprehensive policy and regulatory response. Very interesting. While the financial stability risks arising from crypto asset markets have not materially changed since the publication of the 2023 synthesis paper, the continued growth of these markets and their increasing interlinkages with the traditional financial system could present systemic risks. So their increasing interlinkages with the traditional financial system, like what could that mean? So crypto asset markets rebounded rapidly in late 2023 and early 2024, but remain a small portion of global financial assets. The use of stablecoins for payments and settlement continues to be limited. However, the linkages between crypto asset markets and core financial markets continue to increase and may lead to risks to financial stability. Why do you think that is? That gets back to what I just said in the episodes in the crypto series that I did, where like I said, I think there is a direct connection between the crypto crash of 2022 and the banking crisis of 2023, which caused the failure of at least 5 banks. That's why they're writing that in the concern, but they don't want to say that out loud. They're going to say that in a roundabout type of way. Jurisdictions have made progress. I love how jurisdictions, in other words, all central banks, jurisdictions, all central banks have made progress to implement the policy and regulatory responses developed by the IMF, the FSB, and standard setting bodies. I love SSB, standard setting bodies. Nearly all FSB member jurisdictions have plans in place to develop new or revise their existing regulatory frameworks for crypto assets and stablecoins, or they have already have those frameworks in place. A majority of FSB member jurisdictions and about half of the non-FSB regional consultative groups, in other words, other central banks in third world countries, member countries expect to reach alignment with the FSB framework by 2025. So nobody wants a central bank digital currency, but they're all working on it. They're all working on it, and they're all putting in basically the guardrails, the framework, getting everything ready to go here. So the IMF, FSB, SSBs, and the FATF have conducted outreach in a wide range of jurisdictions beyond the G20 to raise awareness of their policy frameworks. Oh, you bet they have. Yeah, they basically told everybody compliance or else. The FSB and the SSBs continued to act as a hub for information sharing between their member authorities. Of course it did. The IMF has led the G20 Data Gaps Initiative's 3 recommendations, 11 on digital money to address the data gaps on crypto assets. The IMF conducted a stock-taking exercise amongst the G20 and non-G20 FSB jurisdictions, which showed that notable efforts have been made among G20 countries to examine data collection options. Of course, they have. Cross-border crypto asset activities that originate from offshore jurisdictions present elevated regulatory and supervisory challenges for authorities. So, in other words, what happened with FTX? You got to think about this. Like FTX failed. Why? Because they didn't operate in America. They operated over in Hong Kong, and then they went to the Bahamas, and so they operated outside of U.S. jurisdiction. Binance, again, operates outside of U.S. jurisdiction. The only one that really does is, for the most part, is basically Coinbase. And but even they're going through their challenges right now. So, okay. The prevalence of non-compliance with applicable laws and regulations significantly undermines efforts to implement the FSB framework and other international standards on crypto assets. Yes. And in other words, what are they talking about there? Oh, well, the law that the U.S. just passed in the House of Representatives basically saying we don't want a central bank digital currency. Stablecoins should be subject to specific regulatory requirements due to their vulnerability to a sudden loss in confidence and potential runs on the issuer or underlying reserve assets. So again, what are they talking about there? They're talking about the failure of Terra USD in 2022. And how basically you can have a sudden loss in confidence and it can lead to potential runs on the issuer of USD or the underlying reserve assets. Which is exactly the Terra USD situation. The IMF has strengthened coverage of macro financial issues and challenges associated with crypto assets in its engagements with member countries. In other words, they've twisted arms, get them to go along. The IMF and the FSB, together with the SSBs and other IOs, will continue to support and promote a globally coordinated and comprehensive policy and regulatory approach to crypto asset markets. The IMF will continue to support its member countries through capacity development and surveillance. It's an interesting word, right? Surveillance. The FSB will conduct a review of the status of implementation of the FSB framework by the end of 2025. The SSBs will take measures to support their members to implement the relevant standards. So, and then here again, like I said, it gets into the introduction. Promoting, supporting, and monitoring the effective implementation of a coordinated and comprehensive policy and regulatory response to address the risks of crypto assets is a priority of the G20. Now, again, this isn't so much, and it says in September of 2023, the G20 leaders endorsed the crypto asset policy implementation roadmap, which is included in the IMF FSB synthesis paper, Policies for Crypto Assets. And I do have that paper. I'll have to share that with you guys another time. The roadmap laid out both planned and ongoing initiatives by the IMF, the FSB, and relevant international SSBs. And then it goes through what does the roadmap seek to do. And I just want to see, yeah. So basically telling everybody, yeah, we really want to get ahead of this. We want to create our own cryptocurrency, and we want to be able to control the crypto assets. Is basically what's going on there. Okay, market developments, financial stability risks arising from crypto asset markets appear limited at present and have not materially changed since last year. Stablecoins have rebounded and the value of total issuance has grown, but their use for payment and settlement purposes in the real economy continues to be very limited. And then we got some good kind of crypto market asset things here. Nevertheless, the continued growth of the crypto asset markets and their increasing interlinkages with the traditional financial system could present systemic risks, emphasizing the importance of implementing the global policy and regulatory responses. Yes, in other words, what are we seeing right now? You're seeing BlackRock and Vanguard and State Street and all the other big boys. They all want to work through the Commodity Futures Trading Commission, the CFTC. They all want to work through the SEC and the CFTC to basically create all of these, stablecoin and cryptocurrency ETFs and mutual funds that they can then pump out to the masses, have everybody invest in that. And that's an issue because that is putting cryptocurrency more inside the traditional financial system, which could, as they're saying here, eventually propose some systemic risks. So that remains to be seen, but we'll have to see here. And then again, more interesting, basically, so Tether has become the big stable coin right now. And you can see, Tether here, Tether reserves compared to largest US and EA MMFs, money market funds. So Tether's kind of right in the middle now at this point. You got weekly fund flows on assets under management of crypto asset funds. Kind of interesting. Roadmap progress update. So the roadmap highlighted the need for international cooperation as well as effective implementation of the recommendations and guidance developed by the IMF, the FSB, and the SSBs. They have since taken forward work in the 4 areas, including the roadmap, implementation of policy frameworks, outreach beyond the G20 jurisdictions, global cooperation and coordination, and addressing data gaps. So implementation of policy frameworks, high-level overview of jurisdictional, legal, and regulatory developments, expected time to reach alignment here. So we'll, see what happens here. They got a lot of recommendations. And then GSC recommendations here. Expected time. This is for non-members of the non-FSB members. Reaching through there. Implementation challenges for DeFi and MCIs. Let's go down here. SSB's work to support implementation of the policy frameworks. And then, did I skip through that? Yeah. Prudential standards for banks' exposure to crypto assets. This is kind of interesting. In 2023 and 2024, the BCBS also reviewed other bank-related developments and activities in crypto asset markets, including the risks arising from crypto assets that use permissionless blockchains, the risks arising from banks providing crypto asset custody services. Such services raise various operational risks for banks, which reinforces the importance of full implementation of the BCBS principles for operational resilience and principles for the sound management of operational risk. The BCBS will continue to monitor the evolution of banks' crypto asset custody activities and, taking account of market developments, will consider whether any additional work may be needed. And then, so that is exactly the episode that I did on Customers Bank, and that's basically exactly what happened to them. Basically, the crypto asset custody activities. They wanted to know about the activities of what people were doing. So it's very interesting. And then finally, the role of banks as issuers of stablecoins. So, Yeah, I don't know if banks really want to get into being the issuers of stablecoins, but JP Morgan Chase is working on their own stablecoin called JP Coin. And so they've been working on that for a few years now. And I'm sure that they would love to roll that coin out to their customers at the right opportunity. So they very easily could create their own. JP Morgan could very easily create their own stablecoin if they so choose in the future. So we'll have to see what happens there. Follow-up work to the application of the PMF, roadmap to strengthen standards, and we're coming to the bottom here. Outreach. Let's keep going here. Implementation challenges on this. Outreach activities. I'm trying to get to the bottom here. Cross-border regulatory, cross-border coordination, addressing data gaps. Almost there, guys. Almost there at the bottom there, guys. Hold on. Data challenges. Yeah, non-compliance and enforcement challenges. Yeah, there's going to be some. All right, if we could get there. Come on. We got to get. All right, GSC recommendations 9 implementation experiences. They talk about like redemption rights. All right, next steps here. So, and then this is going to go into like kind of a litany of next steps here. So, but basically, as many crypto asset issuers and service providers are still operating without being subject to comprehensive regulation or in non-compliance with applicable jurisdictional regulations, it is important that all jurisdictions implement the FSB framework and relevant international standards fully, consistently, and in a timely manner. So I bet they will. So they're gonna basically, like I said, they've rolled out this roadmap. They're going to continue to push people to try to follow this. So we'll have to, like I said, see how it unfolds. But the annex here, summary of implementation survey, responses to the FSB survey. It's just kind of some actually very interesting. I'm not going to go through all this, but there's some actually, status of implementation by various countries, like who's working on it, who isn't, how far they're along, stage of policy development for new or revised crypto asset regulation. So a lot of interesting stuff here in this report here. So, but okay, so let's move on here to the next one, the financial implication of tokenization. Oh, sorry, going the wrong way here with this. Okay. Now, before I get into this, let me just check a question. So let's say, I do have, Javier has a question here. So why do they make it difficult to purchase crypto with credit cards? Well, again, that really gets into the risks that they were talking about of crypto working its way into the traditional financial system. So, and they're talking, they talk about, at least in that last report that I was just in, the risks of, crypto making its way into traditional finance and causing instability in the traditional financial system. So we'll have to see again how that all plays out. But yeah, I guess that is interesting. Because I think maybe the issue would be there. So let's walk through that for a second there with the whole credit card thing. So I think what you would ultimately have to do, so say you wanted to advance off your credit card to put it into your digital wallet, which you would then, again, use the funds in your digital wallet to purchase the cryptocurrency through like Coinbase or Kraken or something like that. So I think you would basically have to do that as what's called like a cash advance. You'd probably have to do like a cash advance off the credit card to deposit those funds into your digital wallet. And maybe that's where the issue comes in. Maybe that's where the credit card companies are basically saying like, we don't know if we want you doing a cash advance into a digital wallet. Because again, it's kind of pretty easy to figure out if you're putting cash into a digital wallet. It's not 100%, but it's like 98%. Like that's probably what you're doing is you're probably going to go, buy some cryptocurrency to go do whatever it is you're doing with that cryptocurrency. So like I said, so I imagine that might be what's going on. So hopefully, Javier, that answers your, hopefully that it was an attempt to try to answer your question there. So, okay. So let's look at this report. And I want to try to wrap these reports up here in like the next 15 minutes so we can get done this. So, but So this, again, executive summary, intro, background on tokenization, vulnerabilities associated with tokenization, and then it kind of gets down to the conclusion. So I just want to get into real quick. So executive summary. So for the purposes of this report, tokenization refers to a process that involves utilizing new technology such as distributed ledger technology, DLT, basically blockchain, to issue or represent assets in digital forms known as tokens. These tokens may represent existing assets, including financial assets such as securities or bank deposits, or physical assets such as real estate, or new assets that represent a claim against the issuer. The report focuses on tokenization involving financial assets and does not cover certain other digital assets, including central bank digital currencies and crypto assets, which have been the subject of previous reports by the FSB or standard setting bodies. So, so that's kind of whetting the appetite here. So this is really focused more, like I said, on again, this is focusing more on the use of tokenization through a distributed ledger technology, DLT, like a blockchain. So, and then let's scoot on down here to the bottom. I just want to get to the kind of conclusion here. All right, so conclusion. While the scale of DLT-based tokenization is currently small, a number of financial market participants are investing in tokenization projects, FedNow, and public sector authorities are assessing whether tokenization offers benefits for financial systems or increases risks to investors and financial markets. The purported benefits included increased efficiency, including in clearing and settlement, reduced costs, the potential for increased variety of financial products and services, and an expansion of opportunities for the real economy and investors, including by making it possible to fractionalize ownership of assets. That would particularly be for like real estate or gold. However, there are a number of impediments to scaling DLT based on tokenization, including the lack of interoperability of platforms and the unavailability of safe settlement assets on the same platform, or fully interoperable platforms for tokenized assets. So due to its small scale, tokenization does not currently pose material financial stability risks. However, DLT-based tokenization's features have the potential to create financial stability concerns, particularly if tokenization scales. Its vulnerabilities include the potential for liquidity mismatch, excessive leverage, interconnections, asset quality issues, and operational fragilities. They may lead to material financial stability risks when certain conditions are met, which requires authorities' close monitoring. However, there is a lack of information available regarding the size and composition of the tokenized assets market, as well as potential uncertainty in the legal, regulatory, and supervisory frameworks that apply to tokenized assets in certain jurisdictions. And then it just goes on to say, in the light of findings of this report and the rapid evolution of the technologies that facilitate DLT-based tokenization, the following are initial issues for the for the FSB and SSBs and national authorities. Consider ways to address the data, consider ways to increase understanding, continue to facilitate cross-border regulatory and supervisory information sharing. And that is kind of the end of it. So what they're basically saying here, so this again is wrapped around tokenization. So, and like I said, you've got FedNow has basically been built on this. It's been built on blockchain technology. It's been built on tokenization. So if the rails, if you will, are set in place, they've been built, they're there. So if one day, and what they're saying here is that as you try, there is particular vulnerabilities if you try to scale tokenization. In other words, if it's real small and you're just using basically DLT or blockchain technology, is fine. There's really no problem. However, if you try to scale that technology, in other words, if you try to have, say, everybody in the country using a centralized central bank digital currency, that could become a problem because of all these vulnerabilities, because basically the infrastructure, if you will, is not there. And even if the infrastructure was there, you have the possibility for what they call like liquidity mismatch, excessive leverage, interconnections, asset quality issues, basically all issues that can kind of happen in the traditional and have happened in the traditional financial system as time has run by. So okay, so those are those two reports. Now our last two reports here from the Bank of International Settlements. So let's see here, tokenization. I just want to make sure I'm doing the write up on the right one here. I think this is all right. Well, I'll read this out. We'll go through it. So tokenization's impact remains uncertain. So a new report outlines the opportunities, risk, and future considerations for tokenization, or the process of generating and recording a digital representation of traditional assets on a programmable platform. The Bank for International Settlements report contends that token arrangements may facilitate the availability of different assets or currencies and the ability to combine multiple functions on a single programmable platform, which could streamline complex transaction processing. The report notes a range of available options for central banks considering token arrangements, including connecting existing central bank payment systems to outside token arrangements, providing a tokenized form of central bank money on programmable platforms that are operated by the central bank. Wait a minute. Let me read that again. Providing a tokenized form of central bank money on programmable platforms that are operated by the central bank. Providing a tokenized form of central bank money on the same multi-asset platforms where tokenized deposits reside. So that's the one report. All right, and then the second one is stablecoins do not act as safe havens during crypto market stress. So stablecoins do not act as safe havens during crypto market stress, but their market capitalization drops after significant shocks, according to a Bank for International Settlements working paper. The Biz paper argues that U.S. monetary policy experts' extraordinary influence on crypto markets as rising interest rates push crypto investors into traditional assets. So kind of interesting. So we'll kind of dive into this here for a second. So we just had the bank, or I should say, we just did the Financial Stability Board, the FSB, and we just did their report on tokenization. And basically they looked at, okay, so we got tokenization, which is basically built on blockchain technology. We talked about how that's going. Now, this is kind of a different side of it. This is basically the Biz reporting to the G20, if you will, basically saying how they can use tokenization as a way to build a central bank digital currency that can be used by the central banks. So let's go down here. And then obviously, like I said, you have executive summary, introduction, tokenization of money and other assets, programmability, token arrangements, opportunity and adoption of arrangements, combining assets and functions, delivery versus payment, case study. The Biz Innovation Hub projects involving tokenization, risks and challenges, and then considerations regarding central banks' policies. Considerations regarding market developments, considerations for settlement assets, considerations regarding oversight, considerations regarding monetary policy, and then it gets down into the conclusion. So, and then it gets to I want to just jump down here to kind of the conclusion here. Let's see here, conclusion. So let's blow this up a little bit here. So, I love this. The Brazilian G20 presidency has asked the Biz and the CPMI to examine the meaning of tokenization in the context of money and other assets and how to envision a tokenized environment that builds on the best attributes of the current monetary and financial system while discussing potential future implications. This report is a result of that investigation. Its main findings are as follows. So the first problem there is the Brazilian government, the Brazilian G20 presidency. Who is the head of Brazil right now? Lulu. And who is Lulu? Lulu is a communist. Yes, Lulu's a communist. And he would love to have this in place to further control and subjugate his population, just as China would love to have it, just as Russia would love to have it, just as many, many countries around the world run by dictators and communist regimes would love to have this to impose this upon their people, undoubtedly. So that's the first thing. Okay, but now let's run through what are these main findings. First, to understand the meaning of tokenization in the context of money and other assets, it is useful to view it as part of a long-term evolution in market structures. This report uses the term token arrangements to indicate the infrastructure that supports the use of digital tokens in financial transactions. The main finding is that these arrangements that provide platform-based intermediation across the end-to-end life cycle of financial assets may lead to changes in market structure. Well, no duh. Of course, yeah, of course. Second, tokenization may affect how pre- and post-trade functions are executed for money and other assets. It offers opportunities for market participants in terms of safety, for example, through payments and settlements, and increased efficiency, e.g. due to built-in programmability and composability of transactions and process automation and data reconciliation within a shared ledger system. Third, while the potential benefits of tokenization have attracted interest as reflected in investment by private sector market participants and experimentation by public authorities, the costs and risks also need to be taken into account. So, yeah, so they're talking about, high risk, high reward. Fourth, risks that apply to conventional market infrastructures also apply to token arrangements, such as governance, legal, credit, and liquidity risks, or custody and operational risks. Such risks may materialize in a different manner due to the notable features of tokenization. For example, risks may arise due to the separation of the token and the underlying asset, which may give rise to conflicts of interest and to the governance costs of developing, operating, and maintaining shared ledgers. So in other words, they're talking about Terra. Terra is the perfect example of how this blew up. And then finally it gets down into looking forward. Tokenization may have implications for the roles of central banks in payments, monetary policy, and financial stability. A primary consideration for central banks is whether and to what extent to react to ongoing private sector tokenization initiatives. For example, central banks could consider ways to foster interoperability if markets develop a fragmented manner. A second consideration is whether and how central bank assets assess the trade-offs and the appropriate balance between different types of asset or different types of settlement assets and token arrangements. This may include how or in what form central banks could provide central bank money as a settlement asset for token arrangements. A third consideration concerns identifying token arrangements that may already or potentially in the future meet the criteria to be subject to regulation, supervision, and oversight at the individual jurisdiction level. They might also be subject to international standards, such as the PFMI. Relevant authorities might consider how to cooperate both within and across jurisdictions. A final consideration relates to the potential impact of token arrangements on monetary policy implementation, for example, through changes in the structure of regulated markets or the demand for central bank versus other types of money. So, sounds great, written in high level central bankese, if you were. But what that says in a nutshell is that basically they want to continue going ahead with developing this digital ledger technology for the ultimate implementation of a central bank digital currency. And they want to experiment and explore how the central banks would push this on people, what effects it would have on the overall market, how they could control it, what issues may arise from them pushing this on people, and then ultimately how they need to work with other I love it, say jurisdictions, not countries or other central banks. They call it jurisdictions. They have to work with other central banks and other countries around the world to basically implement this one world digital currency and get everybody to jump on board with this thing. So again, that's what I talk about, like reading between the lines when you read this stuff. Okay. Now let's go into our last article. Okay, guys, last article. I appreciate everybody who's been, hanging in here so far tonight. Okay, stablecoins, money market funds, and monetary policy. So what this article basically gets into is, we'll look at the abstract here for a second, and then I'll go and run into the conclusion. So using a new series of crypto shocks We document that money market funds, MMF, assets under management, and traditional financial market variables more broadly do not react to crypto shocks, whereas stablecoin market capitalization does. US monetary policy shocks, in contrast, drive developments in both crypto and traditional markets. Crucially, the reaction of MMF assets and stablecoin market capitalization to monetary policy shocks is different. While prime MMF assets rise after a monetary policy tightening, stablecoin market capitalization declines. In assessing the state of stablecoin market, the risk-taking environment as dictated by monetary policy is much more consequential than flight to quality dynamics observed within stablecoins and MMF. So what does that mean in English? So what they're saying is, if you have a shock to the U.S. monetary system, basically a typical money market fund will be fine. They'll be able to absorb that shock. However, the stablecoin would not be able to sustain that shock, and stablecoin could blow up just like Terra USD did in 2022. So let's go. So in the introduction, it goes into like stablecoins or crypto tokens that live on distributed ledgers and promise to be worth always $1, providing par convertibility on demand. Stablecoin issuers defend this promise by holding mostly fiat-dominated short-term assets such as treasuries, high-quality commercial paper, repurchase agreements, and bank deposits. Combination of money-like demandable liabilities with backing assets that may become illiquid implies that stablecoin issuers' liquidity transformation exposes them to runs. Yes, exactly. And then it goes on to, on aggregate, there is no evidence of inflows into stablecoins during major crypto events, and in particular during the March 2023 banking crisis. Oh, whether stablecoins act as crypto safety haven is still an open question. In this paper, we document an important distinction between stablecoins and MMFs, namely their very different response to crypto and U.S. monetary policy shocks since 2019. Drawing on a new series of crypto market shocks and a standard measure of monetary policy shocks, we show that crypto shocks are inconsequential for MMFs and traditional financial markets, but negatively affect stablecoins. In contrast, U.S. monetary policy shocks significantly affect MMFs and stablecoins, but in opposite directions. While prime MMF assets grow after contractionary monetary policy shocks, stablecoin market capitalization significantly declines. So stablecoins as a whole do not act as safe haven against crypto or standard financial shocks. As monetary policy tightens, crypto prices fall, the market turns bearish, and investors demand less stablecoins. So the settlement means in crypto markets for speculative purposes. So dollar monetary policy, therefore, acts as the key nexus between traditional and crypto markets. So again, very interesting here, right? So let's go down. This isn't a long paper. I think this is only like, this one is only maybe like 20 pages, something like that. But okay, I think I went a little too far here. Yep, we're down in tables. Yeah, let's go back up here. Yeah, this paper itself is only like 9 pages, but then it has a bunch of appendix on it. So in conclusion, we find that negative crypto shocks have no impact on traditional financial markets, including MMFs, and negatively affect stablecoins. In turn, U.S. monetary policy shocks are more important, leading to inflows into prime MFS and much more significant outflows from stable coins. Our results suggest that first, stablecoins' role as crypto safe haven is questionable and does not extend to either crypto or traditional financial market shocks. Second, U.S. monetary policy not only affects traditional financial markets, but also exerts a significant influence on cryptocurrency markets, especially stablecoins. So that's very, very interesting. So, so I think that the question there is that stablecoins are definitely not as secure or safe as a lot of people out there think that they are. So, and thus the need for some level of regulation around stablecoins. So, okay, man. All right, let's go back. Okay, so we covered a lot of ground here tonight. So let me let me do one thing here. Let me just bring back in for 1 second. I want to bring my little PowerPoint back in here tonight, just a recap real quick. Like, so we covered a lot of ground here. I did the recap of the crypto series, the first 11 episodes. I gave you guys a little bit of a lot of cryptocurrency related news that's been coming out. We covered the cryptocurrency debate in the ICBA article. We covered what the majority of Americans, the fact that they're not really that confident in the safety and reliability of cryptocurrency through the Pew Research article. And then we took a look at through the FSB, the Financial Stability Board. We looked at the stability implications of tokenization. And then we looked at crypto asset policy implementation, the roadmap for the G20, which is an update. So, and then from the biz, we saw that tokenization in the context of money and other assets, concepts, and implications for central banks. And then finally, we looked at stablecoins, money market funds, and monetary policy. So, but ultimately in those 4 reports, what did we get? We got that the biz, and you keep in mind, the biz, the Bank of International Settlements, that is known as the central bankers bank. That is where central bankers go. Okay. And I have a whole book on the biz. I'll do a whole book review on the history, the background of the biz. Some of it people will find very shocking. The biz was created after World War I to basically deal primarily between the treaty between Germany and France, but really morphed into a much different entity during and after World War II, and has been kind of at the heart of the global central banking system since the end of World War II, basically. And so the biz is known as the Central Bankers Bank. And, the biz they do some great research. They do some great policy papers over there. I highly recommend go to their website, check it out. I think you'll find some really cool and interesting stuff there. But they are kind of hell bent on implementing this one world central bank digital currency. They absolutely want this thing, and that's what that first paper there, that that G20, that crypto asset policy implementation, the roadmap, basically said, okay, a year ago we laid out this roadmap, and how are we doing? What are we finding out there so far? Then we find out that we look at the biz paper on tokenization, and they talk about how, tokenization can work, but it has some limitations. There's some things we need to work out. And then the Financial Stability Board comes in with further implications of tokenization, basically saying that there are some real challenges to tokenization, how we can use tokenization to basically facilitate a digital currency or a central bank digital currency, and how that's going to work out. And then finally, we get this new report on stablecoins, and basically saying that, hey, stablecoins are not the safe haven asset that we think they are. And they could be, it doesn't, when you compare money markets in the traditional financial system to stablecoins in the cryptocurrency system, we see that basically, if there was a shock in the monetary financial system, then the money market funds are fine, but stablecoins are going to get crushed. But vice versa, that doesn't go the other way, though. If something happens in the cryptocurrency, it's not going to affect the money market funds in the traditional currency. Hopefully everybody's following that. So, but lot of really great information here, and again, this is going on. I would tell everybody, and I'll be covering this more in future episodes, no doubt. But I would tell everybody that 85% of the central banks around the world, they're all working on this. They're all working on that. And that's what the whole article there on the G20 crypto asset roadmap. They called it jurisdictions, but it's not jurisdictions. It's central banks from every country around the world, central banks in like 187 different countries. And they're all working on this. They're all working in some way, shape, or form. Some a lot faster and deeper than others, but they're all still working on it. The Fed is working on it. The Fed now, this new payment system, that was built on what do we call it? The blockchain technology. Why am I asking the defined ledger technology? If I'm wrong, that right, the DLT. That is basically what the FedNow system has been built on. It's basically been built on blockchain technology. So the rails, if you will, are there. If they want to throw a central bank digital currency on top of it, it would be very easy to make the proper adjustments to that system, turn it on, and boom, you're in business. You're ready to rock and roll. So again, this is really, I think this is again really fascinating stuff. I hope that people will get a lot from watching this episode. I hope this will kind of bring people kind of up to date on a lot of things that are happening in the crypto world from a, not from like new crypto currency point of view, but more from a what's happening with the governments and the central banks and potential regulation, and what's happening in the US banking system, and how good is the blockchain technology. Is it really as great as we think it is? How safe is stablecoins? Are stablecoins really as safe as we think they are? Hopefully you got some answers to a lot of that stuff into this live stream tonight. And like I said, if you haven't checked out any of those episodes yet in the crypto series, please check that out. This is absolutely going to be an ongoing series because there is no doubt going to be more information, more reports, more things that are going to come out with this over the coming months and years. And I will continue to cover it as I find things that I think are really interesting to people. I don't want to cover kind of some of the more mundane things that are out there right now. I'm trying to give people like stuff like this, like more really detailed information in the crypto space. So, but definitely go check out the crypto series on basically my channel, The Banker Next Door, and go watch some of those episodes. I think you will learn a lot about the history of Bitcoin and blockchain and other cryptocurrencies, how they came to be, what's transpired in the last few years, what's currently going on, scams and things that are out there right now. So but go check them out. I hope everybody really enjoyed this live stream. If you didn't get a chance to check out the regular BND strategy room live stream last night, I highly recommend everybody check that out. And I do those every Friday at 7 p.m. live here on YouTube. Check out some of my other episodes up on the channel. I've got a ton of content up there, a number of different special series. I'll be rolling out some other stuff in the months ahead. I do some great interviews, other things like that. So hopefully, if you're just tuning into this because maybe you're very interested or fascinated in cryptocurrency, check out some other things on my channel. They've got a lot of great content, a lot of good stuff up there. But I hope everybody enjoys the rest of the weekend. I hope everybody enjoys the rest of the night, has a great weekend. And check out, I will be putting up a bunch of episodes. I have an episode up hopefully every day here over the next 5 days leading up to the next live stream on next Friday, the 8th. And I will see everybody then. Have a wonderful weekend. And see everybody again real soon. Thanks.